All right, well, what we're going to do right now is just simply a very simple walkthrough of the in-class spreadsheet that we did during week 6, where we began our treatment of the internal rate of return and the net present value. So let's take a look at what we have. What we have here, as you recall, is just simply a basic spreadsheet. We've reconstructed an operating statement. We've been given some basic details of a sample investment opportunity that we're considering. In this instance, the deal is on the market or maybe even trading off market for $1.5 million. We said that for the sake of argument in class, we were going to get a loan for $1 million. Therefore, our required equity to close is $500,000. We've not underwritten the loan or anything like that. I just gave some assumptions for this particular in-class spreadsheet. This equity to close of $500,000, we are going to refer as T sub 0. The annual debt service for the sake of argument is $35,000. Also said that given some inflator or deflator over a 5-year hold period, that the gross potential rents are going to be these: vacancy, EGI, expenses, NOI, ADS. Therefore, the before tax cash flow is all here. We did take these numbers out to 6 years because we are going to hold this deal for 5. We said that when we sell the property at the end of the 5th year, that the buyer of that property is going to essentially purchase our year 6 net operating income. Therefore, what we're going to do at the end of this 5th year of hold is we are going to capitalize our anticipated year 6 NOI to the extent of some terminal cap rate. This was just simply a given. All right, so through this reconstructed operating statement, we've got a couple of things going on here. Number one, we can calculate our first year cap rate. You should know how to do that by now. And we can also then calculate our terminal value given a 5.25 disposition cap rate. We capitalize this year 6's NOI to get a terminal value here of approximately $1.93 or so million. We said, for the sake of argument, that when we pay off the loan at the end of year 5, that we're going to pay it off at $650,000. We don't know what that balance is. Technically, right now, we're just using some placeholders to demonstrate the process. We also said that when we sell the deal here at the end of year 5, we're likely going to have some closing costs. Maybe there's a broker fee, escrow fees, title insurance, whatever the Mickey Mouse is at the end of the deal. Therefore, at the end of this 5th year of hold, our net cash flow from reversion on a before tax basis is going to be $1.18 million. Therefore, what we've done here is we've essentially underwritten 3 buckets of money. The first bucket is our time 0 amount to close, right, which we said is $500,000. Our second bucket of money is going to be our before tax cash flows from operations. Okay, so we have 3 buckets: T sub 0, before tax cash flow from operations during the hold, and our disposition. This is going to be essentially V sub T, and I'll format that for you here just so you know. We're going to go to font and just simply do a subscript, bam. So that's our terminal value when we sell the deal. First bucket, second bucket, third and final bucket. What we do then is we come down here and we just diagram out our cash flows during the hold period. Our T sub 0 is our equity in. Our operating cash flows during the hold period, we're just simply going to take from up here. Years 1, 2, 3, 4, and 5. Years 1, 2, 3, 4, and 5. Before tax cash flow from operations, second bucket. Before tax cash flow from operations. The third and final bucket that we're going to drop down here into this little table is our net cash flow at disposition, this $1.18 million. So we just drop that down there. Now we have a series of 5 years of cash flows, as well as our initial equity in. Therefore, to calculate the internal rate of return, we just simply go up to formulas. You can go to financial or recently used, pull down the, or you know what I'll do? I'll just do it my way. It's easier for me. Equals IRR, open paren, click, drag, release, close paren, and hit enter. So this, my friends, is the internal rate of return. And we said in class that the internal rate of return is the discount rate which causes the net present value to equal 0. Therefore, what I've done to prove that is I've just simply taken these future values, right? We're getting this 31.5 at the end of year 1. We're getting this 38.4 at the end of year 2. We're getting 45.3 at the end of year 3, 52.2 at the end of year 4, and 1.239 million at the end of year 5. Therefore, if I take all of these future values and I discount them back at the internal rate of return, this then amounts to a present value of 25,000 and change. Now, these are simply negative numbers because I plugged in a present value formula here for these future values. We know that the present value and the future value must be opposite signs. So what Excel is doing simply is returning these future values here, which are positive numbers, to a present value in a negative number. That's just what Excel does. Okay? Now, if I wanted to, I could simply multiply this times 1 to get the positive number. I would drag these formulas out to get positive numbers. Okay? Just very, very simple. So what I've done here is I've discounted these future values back at the internal rate of return. If I were to sum all of these future values discounted back at the IRR to a present value state, if I were to add then up all of these values, they would equate to 500,000. Therefore, what we've just done is we've proven that the internal rate of return is the discount rate which causes the net present value to equal 0. If I were to take my 500,000 out and add it to the sum of these discounted back future values, we would get a sum of 0. Therefore, we've just proven that the internal rate of return is the discount rate which makes the net present value equal to 0. Okay? We also said in class that given some alternative investment scenarios, in other words, some opportunity cost of capital, then what we're going to do is we're going to take these cash flows and discount them back by the opportunity cost of capital, meaning that if my alternative investment is less than this, the rate of return is less than this IRR, then this net present value will always be positive. All right? Therefore, I'm always going to consider, or usually am going to consider, at least, net present value investments that have at least a 0 NPV or greater. I'm not going to consider any investment that has a net present value of less than 0. Okay? We also said that when we go to the bank to deposit money, we can deposit net present value, but we cannot deposit the internal rate of return, right? So what we need to do is we need to view the IRR and the NPV in conjunction with each other. Don't just look at one and not the other. Don't just look at the IRR, because you can envision a scenario where the internal rate of return might be astronomical, but the net present value might be kind of low, maybe unacceptable. You can also envision a scenario where this internal rate of return might be relatively low, and the net present value be off the charts. So the internal rate of return can sometimes give us some fuzzy or hazy investment decision criteria. So what we want to do always is we want to view the IRR and the NPV as kind of working together in this balance when we're trying to determine if we're going to move forward in this particular investment. All right? So that's a very quick walkthrough of the internal rate of return and the net present value.